Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Philip Peterson, Chief Investment Strategist at IG Wealth Management, will be joining us for the hour. Then in 30 minutes, Stats Canada releasing the latest GDP numbers. Sal Guartieri, Director and Senior Economist at BMO Capital Markets, will be here to help us break it all down. And we want to hear from you, of course, this morning on First Call. Reach out with your questions on portfolio construction, and we'll have Philip answer as many of them as he can at the end of the show. The number to call will be 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Netflix and Paramount are higher in the pre-market after Netflix officially backed out of its bid to acquire Warner Brothers Discovery. The move follows Paramount Skydance raising its offer to $31 a share, a proposal Warner's board has now declared superior. Netflix says the deal, valued at nearly $111 billion US, is no longer financially attractive. Laurentian Bank posted first quarter results that came in below expectations. The Montreal-based lender missed on profit and also reported a net loss of a little more than $20 million. Laurentian says the quarter was hit by costs related to its strategic shift. The lender is transitioning to becoming a specialty commercial bank and exiting retail and small banking. The CEO says the performance reflects a pivotal step in the bank's ongoing transformation. Shares of Block are surging in the pre-market after the company announced it will lay off more than 4,000 employees. The fintech company, formerly known as Square and founded by Jack Dorsey, says advances in AI tools have changed how the business operates. Dorsey noted that a smaller team using these intelligence tools can now do more and do it better, a message that has sparked a wave of AI-driven optimism among investors. And now our top line story. Netflix, as we mentioned, has dropped out of the fight to buy Warner Brothers Discovery, clearing the way for Paramount Skydance to clinch the deal for the historic Hollywood studio. For more on this and his thoughts, let's bring in our guest for the hour, Philip Peterson, Chief Investment Strategist at IG Wealth Management. Philip, thanks as always for joining us.
Hey, thank you for having me.
Yesterday, it looked like there might be a few more rounds to go, and then all of a sudden, today we're done.
Exactly. And you look at how the market is responding. They're responding favorably that Netflix is not part of this deal. I mean, it could have been a financial burden for them. But also read between the lines what we've been hearing over the past couple of days to couple of weeks is from the political element of it, the deal might have had trouble getting approved if it was Netflix being the ultimate winner here. So perhaps they saw this as, do we really want to burden ourselves financially and burden ourselves politically, or should we just call it a day?
Yeah. Would they have gone any higher? Just take out the politics for a second. Would there have been a reason to go higher?
Well, I think it's difficult. I think if you look at it right now, perhaps the valuation's been a little bit stretched on this property. And so wisely, I think they backed away and said, okay, you know what, we've put up everything that we thought was reasonable from a financial aspect in terms of the return that we could generate on this asset. And this was the line in the sand. So I don't know if it could have gone higher following all the steps that we've seen up to this point.
And now going the other way, did Paramount pay too much?
Well, that remains to be seen. If we look historically, I would say that, yes, transactions like this of this size, down the road, you look back at them and saying they probably paid too much or they didn't acquire all the synergies that they were hoping to. We'll see ultimately what happens down the road.
And how much of a factor, we're going to talk to politics in a second, but Larry Ellison, how much of a factor was he in all this? Did he want this badly? Is this something he really wanted to?
It seems, well, based on how aggressive they were in terms of the bidding, it seems that they did want this badly. And when you see again, I don't want to draw too much of a conclusion here, but some of the politics that went on in the press seems that his side was favored more than the other side. And so in order to perhaps leverage the political relationships that he has, it does indicate that, yes, he wanted it and he was willing to go pretty far to get it.
And there was lots of meetings going on at the White House yesterday. I'm sure different people were scurrying in different doors at different times. And that was obviously the White House is kind of overseeing everything right now. It feels like, isn't it?
That's it. It starts and stops there. And again, coming back to it, some of the comments being made about Netflix's board over the past couple of days might have been that kind of shot across the bow, saying you can keep going, but you might not get approval.
So what does Netflix do now? I mean, everybody said this is what everybody needed to acquire was Warner Brothers. Is there anything left for them, or are they just going to have to refocus and retool? I
think they refocus, retool. They look at what they can do with that dollar commitment that they was going to steer towards Warner's and put it into new content creation. I think that's ultimately the future for Netflix here.
And Paramount, what do they have to do to make this thing work?
Well, it looks like they're going to try and be competitive with Netflix or Disney Plus or the other streaming platforms. And when you acquire the assets of Warner and everything that you have in there, they have a good starting point. Mm-hmm. But it's building the subscriber base, building the infrastructure around it. That's going to take time. And the returns, I think, are longer dated than what the market may be anticipating, given the response that we're seeing in the price.
And is older content more financially viable than new content?
Sure, it's cheaper, right? It's already been made. The production costs are already there. If you think about it, cents on the dollar. I mean, you're getting it at a bargain, and you can just recycle it over and over again. There's a whole generation of viewers out there that have never seen shows like Cheers or Night Court or whatever it might be, that
showing your age.
I know, exactly. But this is it. This is the benefit of these old catalogs, that you can just recycle them and remonetize them over time. So a bit of a miss for Netflix, but the market seems to like that they're not a part of this.
Yeah, I mean, the numbers were up in early trading. Are there any other possible? Can you see any other situations like this, another big merger, or is that?
I think that's about it. I mean, you had Fox taken out, you got Warner's taken out. It's hard to see what's left. I mean, you have Lionsgate there, but much smaller catalog. But potentially that could be a target at some point in the future as well.
And then Disney is looking at this going, what does Disney do? What does Amazon?
I think Disney stays along the path. I think, they've seen success recently with Disney Plus. They've seen subscriber base go up. They're profitable now in terms of this venture. And I think they just keep doing what they're doing. They have to steer the ship right in terms of the Marvel properties and the Star Wars properties. But I think if they do that, then they can compete toe to toe with the Netflix.
My producer just came in my ear and said, in the immortal words of Porky Pig, that's all, folks.
Exactly.
We got to take a break right now. We'll be up, but we'll take a look at the markets before the bell. Paula, thank you for that. All right, let's see how things are shaping up on the markets. We'll start with the U.S. futures. And it's definitely a risk off this morning. NVIDIA and other stocks, along with inflation data coming out this morning. You can see everybody is off right now. Dow by 0.77. NASDAQ and the S&P 500 by more than 0.6. In Asia, so the markets do a bit of a mixed day. The Nikkei again pushing up near record territory. The Hang Seng also up today, 0.95%. The CSI 300 off by about a third of a point. Heading to Europe, solid earnings momentum and cyclicals are pushing the markets up for the most part. The CAC Drone just taking a bit of a turn lately. It was up earlier. FTSE's up half point. CAC Drone off by 0.22, and the DAX up by 0.1. And the TSX, boy, oh boy, it is having a good week. It was up by 1.1 yesterday. Well, back into record territory. Third day in a row for that. It's up at 34,501. And it's up 9% for the year. Energy and banks leading the way. The banks having those strong earnings, most of them. And some of the winners and losers from yesterday. Look at Enerflex up 17.66%. Northland Power up 8.34. Gildan going the other way, down 3%. Celestica off by about 5.2. And turning to the metals, all of them in the green right now. Gold back up above 5,200. Below its January highs again. Silver on another rise right now. It's up nearly 4% at 91. And copper staying above $6 a pound right now. It's up about 2%. Looking at oil, Yesterday, Western Canadian Select up just barely 0.12%. And south of the border today, WTI surging after a bit of a dip yesterday. It's up 3.3%, over $67 a barrel. Dueling speeches yesterday from two key political figures. Conservative leader Pierre Poilievre has shared his vision for Canada-U.S. relations. He also took aim at U.S. President Trump. Well, we had another speech going on as well. Two key leaders trading visions in sharp public addresses on who is leading trade negotiations. CTV senior political correspondent Mike LeCouture has more.
What President Trump says about Canada is wrong.
It's the strongest language Pierre Poilievre has used against the U.S. president to date. In a speech to the Economic Club of Canada, the Conservative leader laid out how he would deal with the American administration if he was leading Canada. He also took a shot at Prime Minister Carney's assessment of the global trading system.
We should not declare a permanent rupture with our biggest customer and closest neighbor in favor of a strategic partnership for a new world order with Beijing.
Poilievre told the Bay Street crowd he wants to negotiate a new tariff-free auto pact with the U.S., an end to sectoral tariffs, the revival of the Keystone XL pipeline, and a full exemption from Buy American provisions.
I think that Canadians are expecting on this an existential issue for many Canadians, a signal from the opposition leader that he has some solutions.
While Poilievre was offering his remedies for the issues with our ally, the minister responsible for trade with the U.S. was giving his own update on negotiations and setting expectations for hard-hit industries like steel, aluminum, lumber, and autos.
But those will be bilateral arrangements. Sort of adjacent to would be the bureaucratic phrase, the trilateral trade agreement.
While Poilievre has proposed a cross-partisan team to help with the CUSMA review, it's unclear if the government will accept the offer. Meantime, Minister LeBlanc confirms he will meet with U.S. Trade Representative Jamieson Greer in D.C. next week.
And that was CTV's Mike LeCouture. Now for more perspective on Canada's trade position. There's actually a lot going on today. Philip Peterson is Chief Investment Strategist at IG Wealth Management. Sorry, Philip, we spell our names completely different and pronounce it exactly the same. Thanks for joining us. Let's talk a little bit about Pierre Poilievre and what he had to say. A very different Pierre Poilievre.
Very different, and I think what he has learned is don't repeat the mistakes of the election campaign of last year. If you want to succeed as prime minister going forward at some point in time, it's refreshing as opposed to just saying no, everything's wrong, everything's wrong. He's actually coming to the table with solutions, real solutions, and seemingly he's reached out and said we're willing to work with the government to set the course in the right direction. And that's encouraging. That's what you want. And this is how a minority government should work. You all come together to see what's best for the country.
Well, it's healthy, I think, for everybody. And it does show a different side of Poilievre. I mean, he wants to see a committee struck, a multi-party committee that will be working on this, which I think is important because you want to be able to hear all voices on this.
Exactly. And think about it. I mean, you can almost carve up the country in terms of conservative and liberal. And so you want that regional representation coming together. You don't want what has seemingly started to bubble up, which is Alberta saying, well, we're just being ignored. We're just going to go our own way. You want to pull everyone together saying, look, let's do this in the best interest of the nation, which includes every single province and territory.
And also it was interesting, he mentioned Trump by name because his last speech, he didn't mention Trump at all. And this time he actually...
Well, again, I think this is trying to change the perception where maybe a year and a half ago, what Poilievre was saying seemed to sound a lot like our friendly neighbor down south. And now he wants to distance himself from that image. And I think it's the right thing to do. You want to carve your own path and be your own person.
But still push, and I think a lot of people think this is important, still push that the U.S. is still our key trading partner, not China. And we're going to talk about China in a second, but on that one there, that the U.S. is still our big trading partner.
Absolutely. It's more than 70% of our exports going to the United States. You can't ignore it, and you can't turn that on a dime. You can't automatically assume that China will replace all of those exports or that demand from the United States. Still very, very important, and we need to respect that.
Yeah, and now bringing China into this, some changes with canola just announced today that they're going to finish their investigation. We may see them eased by March 1st. Also, the lobster and crab, those tariffs, the 25% tariff that was put on those, they will likely be suspended. Actually, now they're saying China's set to completely remove the 100% tariffs on Canadian canola meal and pea imports, but not on canola oil. That's still being discussed. How does this play out here at home, do you think? And how does it play out south of the border?
Right, so it's positive, right? And this was all a negotiating tactic. I think when the tariffs were put on, it was, hey, we're going to do this because we don't like what's going on. And so this is just getting back, setting it back to ground zero, I would say. In the United States, I don't know if it would have that much of an impact. I mean, I don't think that we're displacing anything from the U.S.-China trade. What we're doing is just getting back to where we were, call it a couple of years ago.
But politically, though?
Politically, you're hearing, if you turn on the news in the United States, you hear the commentators say, look, Canada and China, that's not necessarily good for us. And they don't like that. And you can argue that, look, what the U.S. is trying to do is squeeze China. This is why Venezuela happened earlier this year. It had nothing to do with oil, had everything to do with oil going to China. And so, yes, I think the U.S., this probably ruffles their feathers a little bit, but what's the alternative? If you're shutting us out, we have to go somewhere else.
Where do we go? But, I mean, could China, do you feel, would it be possible, you think, to replace everything in the U.S. or even a large percentage of it?
I think it replaced, yes, part of it, not all of it, certainly, because there are too many interconnected industries between Canada and the United States that are going to exist going forward, like the auto industry, for example. But as far as agricultural products and other mining, and so on, yes, I think China can increase demand.
I mean, oil is a big one, but we have to prove we can build pipelines and build.
That's our challenge.
Infrastructure, right?
Yeah.
And
the demand is there. We have to.
We're talking about it.
Yes.
We're talking a good game. Is there a reason for optimism? Does this look like incentive to start trying to push those through?
Absolutely. I mean, you're hearing more and more about it. I mean, the current government has taken a reversal on the prior government, which was energy bad. Now we're saying, well, no, you can do both. Be climate responsible and embrace your energy infrastructure and energy sector, in which I think we need to as a country. That is one of our primary resources, and there is global demand. It's going to remain with us for decades, so we should exploit it.
Okay, we'll take that. And we'll take a break right now, but we'll be back with Philip Peterson, Chief Investment Strategist at IG Wealth Management, to see why the energy sector is on his radar. Time to see what's on the radar for Philip Peterson, Chief Investment Strategist at IG Wealth Management. And a few sectors to talk about. First up, though, energy. And lots to like about it right now. I was just looking for the energy index on the TSX up nearly 19% for the year.
Exactly, year to date. So we're not even out of February just yet. And yet we've seen significant gains out of the energy sector, not only the producers themselves, but energy services companies. And the reason why we believe we've been bullish on energy since tail end of last year. And if we went back to that point, everyone's talking about oil glut, oil's dead.
They were saying a million plus barrels a day.
Exactly. And while that's true, we do see excess supply right now, but look at where we're going, right? And we often say the cure for low prices of oil is low prices of oil, meaning producers stop investing in new wells, and gradually that production starts to roll over. And that's what we're starting to see in the United States, going from about 13.5 million barrels a day, rig counts dropping. We could see oil production in the U.S. drop off 1 million, 2 million barrels before the end of the year. And that is what's being, I think, priced into the oil producers and the price of oil at 67. So part of it is geopolitical risk, what's going to happen in Iran. But part of it is, hey, we know that this glut isn't going to be long lasting because there's no new production coming online. And that's starting to push up, the producers as well as the services companies.
But is OPEC Plus not talking about at their March meeting that they're going to ease up?
They in terms of increasing production, if they have production to actually increase, and that's the question is we believe that the only country that has any spare capacity might be Saudi Arabia, but they're at the upper end of that. They don't have much spare capacity to go, so they can say we're going to increase production, but where is it actually going to come from? And that's the big question. It's more talk than action.
And so where does that leave Canada, the oil companies here, leaves them in a good spot?
Right. It leaves the energy sector in a very, very positive spot, leaves the TSX in a very positive spot. Globally, if you want to play oil, one of the safer ways to do it is to buy the TSX. Our index is highly correlated to the price of oil. And if you look at the correlation between the other sectors and oil, still very strong. And I think that's obviously one of the reasons why we've seen the TSX outperform this year, and our expectation why it's going to continue through the remainder of 2026.
What about Venezuela for that? How much of a factor is if we start losing the oil going south
right.
to
so
Texas and
this is a big question. Well, will we actually lose it? No, we won't, right? If you look at the pipelines coming from the oil sands into the United States, going to a different location than where Venezuelan or heavy oil is coming in from the Gulf. So we're not going to see one displace the other. And even still, listen to what the energy executives are saying in the United States when they had that round table, and Trump said, "Here we go. Here's Venezuela. It's open for you." And they're saying it's too expensive. The infrastructure is too antiquated. We're not going to invest that at this point. With these prices, it just doesn't make sense. So Venezuela wasn't so much opening of the tap for U.S. oil producers as it was choking off supply to China. And in our view, and we saw the reaction, from the drop in oil prices with the capture of Maduro to the very, very quick recovery and the gains. So it doesn't really have anything to do with Canadian oil.
All right, want to jump metals next. I mean, while silver, it's in its own little spot there on what it's doing, depending on the day, depending on the moment. But gold, what are you seeing? What are you liking about them?
Right. So we've been bullish on gold for a while now. That's a couple of years now. And the way we measure gold is relative to the money supply. And that's a better measure of inflation as opposed to CPI. And we've seen gold re-rate higher to M2 and continues to move higher. Now, from our fair value range, it's at the upper end. But what do we know, right? We know that the U.S. is running at close to a 7% deficit. We know that they're going to roll over a lot of their debt, and this debt is becoming more expensive. So that actually, and we're seeing, kind of a soft de-dollarization going on around the world. That's good for gold. As the U.S. dollar weakens, gold prices move up. As money supply increases, gold prices move up. So, we could see gold move up, not to the extent that we had last year in the 65% range, but could we see it, 10 to 15%? Sure, I think we could from here. And so we still like gold, still own gold. The gold producers are even in a better position because they're leveraged to the change in the price of gold. That's why they, for every, for example, 1% that we're seeing the price of gold move up, they're moving up 2 to 3.
All right. And we got about 30 seconds, for software. We're almost out of time because we're going to hit a time here. But software, where do you see that going?
Yeah, we've seen it taken down quite significantly over the past couple of weeks on this AI fear, but we think it's overdone at this point or close to it. Not every software company is going to be mothballed because of AI, especially the cybersecurity companies. I can't see any CIO or CTO going to their board saying, yes, we're going to let AI run our cybersecurity now instead of CrowdStrike or whatever the company is. It just makes no sense.
All right, we're going to wrap it up there, but thanks as always for joining us. Still ahead, we'll be breaking down numbers on Stats Canada, the latest fourth quarter GDP, and our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266 or send us an email, firstcall@bellmedia.ca. China will begin halting tariffs on Canadian canola starting next week. The move comes after Prime Minister Mark Carney's visit to China in January, where a deal was discussed to drop tariffs on canola, peas, lobster, and crab in exchange for Canada cutting tariffs on Chinese EVs. However, how far those tariffs will fall is still uncertain. Carney hinting they could drop by around 15%, though final details have not been confirmed. Shares of Netflix and Paramount are higher in the pre-market after Netflix officially backed out of its bid to acquire Warner Brothers. The move follows Paramount raising its offer to $31 a share, a proposal Warner's board has now declared superior. Netflix says the nearly $111 billion deal is no longer financially attractive. Laurentian Bank posted first quarter results that came in below expectations. The Montreal-based lender missed on profit and also reported a net loss of a little more than $20 million. Laurentian says the quarter was hit by costs related to its strategic shift. The lender is transitioning to become a specialty commercial bank and exit retail and small banking. The CEO says the performance reflects a pivotal step in the bank's ongoing transformation. And a quick look at the markets. Lots of red right now as we get closer to start of the trading day. You can see the Dow up by more than 1.1. The NASDAQ dropping by nearly 1%. And the S&P 500 future also dropping right now. It's down by 0.9. And see some of the reasons for that might be due to what's coming out here. Some numbers being released today in the U.S. And Stats Canada has just released the latest Canadian GDP numbers. Real gross domestic product declined 0.2% in the fourth quarter in 2025 after rising 0.6% in the third. The fourth quarter decrease was due to withdrawals of business inventories following inventory accumulations in the third quarter. For reaction and in-depth analysis, we are turning to Sal Guattieri, Director and Senior Economist at BMO Capital Markets. Sal, thanks very much for joining us.
Welcome.
Initial reaction to the numbers, they're just coming in now. Off for the quarter, up slightly for month over month compared to the survey. Are you surprised at that?
It's a bit surprising, yes. We thought the number could be either side of zero. We were expecting just a very slight increase in the quarter. So a bit of a disappointment. So that's 2 quarters out of the year where we saw the economy contract back in the second quarter, obviously because of the trade war. But it does appear that ongoing uncertainty about trade policies continuing to weigh on business investment, and that's what's keeping the economy down towards the end of the year.
Saul, it's Philip Peterson. When you see this number in the latest NPR report by the Bank of Canada, they had 1.1% for 2026. Now, this is fourth quarter, but do you think this weighs on their decision for the potential of further interest rate cuts through the remainder of this year?
Well, I think the bar is pretty high for the Bank of Canada to do anything on interest rates. This number is a little weaker than the bank was anticipating, but not weak enough to spur another rate cut. I think unless the economy shows more sustained weakness, or the labor market shows sustained weakness, I doubt very much the Bank of Canada is inclined to cut rates. They seem pretty comfortable with where interest rates are right now. They believe they're adding some modest stimulus and support to the economy. And remember, Q4 is just the one quarter. There was a lot going on in that quarter. We are anticipating an improvement in the economy in the first quarter of this year, and actually through this year as well, in response to previous interest rate cuts and plenty of fiscal policy support. So what it comes down to is that the economy last year, when you look at the start of the year to the end of the year, grew at around 1% rate. That was a big step back from 2024, where it grew at a 3% rate. This year, 2026, we're probably going to see something in the middle, in between, around the 2% mark. But that's pretty decent growth. And I think as long as that's on track, Bank of Canada will refrain from cutting interest rates. At the same time, we'll take much stronger economic performance, much more improvement in the labor market before the bank even entertains the idea of raising interest rates. So we see the bank on hold right through this year and well into next year as well.
I just want to talk a little bit about trade right now. The exports and imports rose in the fourth quarter, but decreased overall for 2025. Which of those numbers is the more important one to you?
Well, I think it's a number for the fourth quarter because it's the most recent figure we have for exports. And it's very encouraging that we are seeing some improvement towards the end of the year, even as you mentioned, for the entire year. Exports were down. A lot of that, of course, in the second quarter when we took the full brunt of those hefty tariffs on steel, aluminum, motor vehicles. But it does look like our exporters now are adjusting to this new higher level of tariffs. And as long as we don't see tariffs increase further, I think it's looking pretty good. The Canadian dollar is still relatively cheap against the US dollar and other currencies. So that's providing some support to our exports. So I would put more weight on the fourth quarter export rebound as a sign of better things to come for 2026.
And along the same lines there, Sal, when we're starting to see some of the data out of the United States manufacturing data improve, we're starting to see the trucking data increase. Do you think this is a sign that we can see a spillover into Canada that could lead to better economic growth, or were the risks to the upside when we see some of that data south of the border?
I do, yeah. It's very welcome that the U.S. economy is maintaining this resilience. We are actually starting to see some signs, encouraging signs of a recovery in its very depressed manufacturing sector. Now, some of that is in response to some reshoring, and because of the tariffs are crowding out some imports. But overall, the fact that the U.S. economy is remaining quite healthy is providing that support to Canadian exports that we've lost because of the higher tariffs, especially on those three very impacted industries. So overall, if the U.S. economy continues to grow at least at a decent rate, and we see it growing above 2% this year, that will provide some nice support to Canada's exports this year, and indirectly or directly impact push our economy forward.
And just looking at one of the numbers, staying in Canada, household spending was up for the month after the drop in the third, or not for the quarter is up 0.4% after that drop in the third. Any clear reasons for that? Are we seeing?
Well, consumer spending has been very uneven through last year. It was very strong in the second quarter, partly because of the Buy Canada movement, and also because of interest rate reductions. We start to see some of that spending slow through the second half of the year. But it is encouraging that we're still seeing households spending. We've taken a bit of a hit, I believe, probably in the first quarter of this year, partly because of the snowstorms across central Canada. But overall, we think Canadian consumer spending won't be terribly strong this year, but won't be weak either. As long as job growth holds up to some extent and wages continue to rise and the economy overall improves through this year, we think consumers will do their part to push the economy forward. What we really need now is business investment to come back in a big way. Unfortunately, that's unlikely to happen until we get some clarity with respect to trade policies, in particular with respect to the USMCA renegotiations. And that may not be settled until next year, maybe even the year after that. So I think that will put somewhat of a brake on business investment. So really, it will be consumers, government spending in particular, and perhaps even exports pushing our economy forward this year.
Okay, Sal, thanks as always for joining us. We appreciate it.
Welcome.
Sal Gualtieri is Director and Senior Economist at BMO Capital Markets. Still ahead, today's market drivers with Bloomberg's Divya Balji. And of course, our phone lines are open. Philip Peterson, Chief Investment Strategist at IG Wealth Management, is taking your questions on portfolio construction. Call us at 1-855-326-6266. Or you can email us, first call at bellmedia.ca. For a look at some early market movers, we're joined now by Bloomberg's Divya Balji, Managing Editor for Breaking News in the Americas. Divya, thanks as always for joining us. Well, we've been talking about implementing AI, and Jack Dorsey's block is doing so, but at a big price for workers.
Yeah, that's right. I mean, quite the shocking news yesterday afternoon, I would say. You know, they're cutting about 40 to 50% of their workforce. That's actually pretty massive. I mean, anyone that was talking about how AI would mean a lot of job cuts, we are now truly seeing that purely from the perspective of Block. Now, Jack Dorsey has always talked about how AI is going to help with the company's growth. You know, this is the future. But I think that level or that extent of job cuts, no one was truly expecting. Now, Dorsey's talking about how AI is truly going to increase productivity without having so many people working. And that's what he's trying to do right now at this point. Now, the market was really liking it. The stock is up. I think when you look at what analysts are saying, it's a very bold move that he's making. It does make logical sense that you think about AI and you think about efficiency and productivity. A lot of companies are looking at that, but no one was expecting the extent of job cuts. And I think that's really what shocked the market yesterday. They also reported solid results. I think that kind of got lost in all of the news when it came to the job cuts that the company announced.
Okay, and OpenAI in the news as well.
Yeah, another big breaking news that just happened a couple of minutes ago, I guess. They've got this new funding round that they're going through. They're looking to raise $110 billion, I believe is the number, and their valuation is sitting at $730 billion. Amazon is one of the big investors. I believe they're putting in $50 billion. NVIDIA is another one. SoftBank is another one. A lot of very big names. Amazon seems to think that they can take on a lot of what OpenAI is doing in helping with the company's own productivity. So again, a lot of these are, AI is just the hot topic right now, and a lot of this is about improving productivity and efficiency at companies.
And right now, though, I was just looking at the markets off quite a bit. And is that most of that reaction to that, or are there other reasons?
I mean, I'm sure there's a lot of concern around the tensions in geopolitical tensions that are going on out there as well. I mean, you're also looking at things from the perspective of what's going on with Anthropic right now in the Pentagon. Anthropic is not budging. When Pentagon was giving it an ultimatum, and Anthropic has said they're not going to accede to the Pentagon and the Department of War right now. That could be some of it. People may not really know what to do with all of this news that they're getting around AI as well. You had CoreWeave that reported results, and investors are not happy with those results because they seem to think that the company is spending too much on AI infrastructure. So I think there's just a lot going on in the market right now. There's also this private credit blow up. I think it's just very jittery at this moment.
Yeah, the CoreWeave, those mixed earnings not sitting well.
That's right. It had it announced a pretty bad loss for the quarter, larger than expected. I think it seems like the street is really focusing on the fact that it's sort of forecasting to spend about $30 to $35 billion, I believe, in terms of AI infrastructure spend. That seems to be well above what analysts were expecting. So that's definitely hurting the stock right now, too. People seem to think it is spending too much on AI infrastructure right now.
All right, we'll leave it there. Divya, have yourself a great weekend. Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Palantir. Let's take a look at some of the notable analyst calls and recommendations. Palantir Technologies is being upgraded to buy from neutral at UBS, the latest firm to turn more positive on the software company in the wake of its results. Investors should take advantage of recent weakness for the premier growth story in software and a company that is at the nexus of the two most powerful spending trends, AI and data, writes analyst Carl Kierstead. PT set to $180 implies a 32% increase from last price. Honeywell International is also rising in the pre-markets after Wolfe research analyst Nigel Coe raised the recommendation on the industrial giant to outperform from peer perform, citing the approaching spin-off of its aerospace business. We are approaching the envelope in which spin situations are generally viewed as more interesting and when investors focus more on sum of the parts, the analyst wrote in a note to clients, adding that there's more value to crystallize from the spin because aerospace and industrial peers have re-rated this year. PT set to $293, implying a 22% increase from Thursday's close. For more on this, let's bring in Philip Peterson, Chief Investment Strategist at IG Wealth Management. Palantir, I think it feels sometimes like a lot of people don't know what to do with it.
Exactly, and these two stocks are a great example of what's going on in the market right now. You have hard assets, Honeywell versus soft assets, intellectual capital, and so on, Palantir. And you've seen kind of like the Palantir softness recently. I had a great run up in the last couple of years, but it's facing the headwinds like all companies in the AI tech space are right now versus Honeywell being embraced. So this is what I think the markets are focused on. They don't know how to make sense of the AI trade right now. There's a lot of uncertainty around it. So what do? You go to where it is certain and you lean in on those hard asset industrials.
Well, and the market's like that. And it's probably healthy, actually, that maybe a little bit of a check right now.
It's a huge rotation going on under the surface of the S&P 500, where you've got half the companies down more than 10% from the 52-week high. That's a healthy market. And even though the market is flat over the last 5 months, it means that we are seeing this good rotation. Overall breadth is broadening out. You're seeing participation by non-traditional or let's call it non-AI companies, which is a good thing that have been ignored for so long. So it's a positive overall.
With what we're seeing with AI over the last couple of days, I mean, with Dorsey at Block, is that going to push more people away, or will that bring them back, do you think?
I think it's going to push people away because it's going to create this uncertainty of, okay, you're going to cut half of your staff. Is that too much or going too far? Are cuts too deep? And it keeps centering around the uncertainty of, okay, we know AI is a powerful technology, but just how powerful it is and how much it can replace, we don't know. So when you're uncertain of certain things, you move to certainty again, and that's moving to these, again, traditional companies like the
old school.
Exactly, bricks and mortar.
All right, we'll leave it there for a moment. When we come back, Philip Peterson, Chief Investment Strategist at IG Wealth Management, takes your questions on First Call. Time for First Call and first email. For that, we head to Chad, who asks, where are we in this economic cycle, and what does that mean for sector positioning right now? We were just kind of chatting about that, weren't we?
Exactly.
Where are we?
Well, we believe we're early cycle. And if you look at some of the indicators out there, and I mentioned it earlier, the transports, we're looking at the rails, we're looking at trucking, we're looking at Dow Transports Index. They've all kind of hockey sticked up after a lengthy downtrend. And that usually is an early cycle indicator that the economy is starting to pick up. Now, some would argue, oh, maybe we're late cycle because this has been going on. We seemingly have been in an economic upswing since COVID, but we would say that we've had a renewal to this cycle starting post-Liberation Day last year. So we actually believe that we're much further away from a recession now than where we were a couple of years ago. Perhaps we had a rolling recession or a mini recession in 2023, early 2024. That's behind us. Now the economic indicators are to the upside. We're seeing positive inflection points as opposed to negative inflection points, and that's positive for markets.
Is there a normal cycle, or is really, I mean, the cycle is just an average of all other cycles? Because I mean, if you look at the last 6 years since the pandemic, nothing's really been normal, has it?
No, it hasn't. We've had an inverted yield curve. We've had weaker manufacturing. We've had weak LEI, leading economic indicators on its index. So it hasn't been normal, but we've seen parts of weaker economic activity, if not a whole full-blown recession. But if you recognize that and you say, okay, well, we can put that behind us, where are we going forward? And this is what we focus on, because why are recessions important to pay attention to? They bring about bear markets, right? Real destruction of capital. So if you can reduce the risk of recession in the next 12 months, you're increasing your risk of positive returns. That's where we are. You lean into equity markets in this environment.
Okay. Let's get to an email from Charlotte. Are we in a stock pickers market, or is broad exposure still the smarter play?
Great question here too, and I think it leads or extends from the conversation we just had on what's going on underneath the S&P 500. So this comes into the question of, do I lean into active managers or passive indexes? And I think there's a room for both in portfolios. We use both in our portfolios. In some cases, I want that passive exposure. In other cases right now, with respect to the United States and the S&P 500, look, there are fantastic opportunities that aren't being reflected in the performance of the index because of the weights of NVIDIA, the weights of Amazon and Microsoft and others that have been down over the past couple of months, keeping that index flat. So in this environment, I would say with respect to the US, active managers are likely to outperform. But in other areas like the TSX, I like passive there.
And just go for the ride.
Exactly.
All right. Corey, I want to get a couple more emails in before we run out of time. This one from Corey. The U.S. continues to outperform on earnings growth and innovation, particularly in technology and AI. Is that structural leadership sustainable, or are we reaching valuation extremes that argue for international diversification?
This is a very, very popular question right now, and we've seen international equities outperform through 2025 and outperforming year to date in 2026.
Well,
we would include
TSX.
Exactly. We think of it as the U.S. and the rest of the world.
Yeah.
The rest of the world is doing very, very well. And why? Well, I think if you want to characterize the S&P 500 in general, it's an AI index. It's a technology index, and there's a lot of questions around the viability or what AI means for businesses. Are we over-investing? Whereas the rest of the world, like the TSX is a commodity and bank-centric index, not AI-related at all, and it's benefiting. If we look at international indices, same thing. They're less AI-sensitive and more hard asset sensitive, and so they're benefiting as a result. Should we be investing in international equities? Yes, absolutely. At this point, I think it's a great idea.
And where do you look? I mean, do you go emerging markets or stays?
Both. Well, our highest conviction is in the emerging markets right now, and that would be our largest relative overweight. And the reason why is that the emerging markets relative to the S&P 500 is trading at the deepest discount that we've seen in a number of years. Strong earnings growth, better margin of safety in terms of the price, and as the U.S. dollar continues to weaken, that tends to be positive for EM. And so we've seen that play out. Emerging markets in Canadian dollar terms year to date are up about 12%, and we think there's still a good runway here.
All right, and we're almost out of time, but we're going to get one more email in from Claire. What's the biggest mistake retail investors are making right now?
What we hear from our clients is they're investing in their portfolio reflecting their political views. And so we're hearing, I don't want to own the United States at all. And so, well, that's the wrong thing to do because you hurt yourself more than the message that you think you're sending. So historically, politics don't have a lasting impact on market performance. Companies will perform well regardless.
I got to cut you off there, but Philip, thanks as always for joining us. Have yourself a great weekend.
Thank you.
Philip Peterson, Chief Investment Strategist at IG Wealth Management, for joining us today. Thanks very much. Andrew Bell's up next with the Open. Trading gets underway in a little more than 30 minutes. Have yourself a great day and a great weekend.